All right, welcome everyone to this explainer. Look, if you're a CA student, a tax professional, or really anyone navigating the financial world, you already know that grasping the absolute basics of the Income Tax Act is, well, it's non-negotiable. So today, we're putting a laser focus on Section 15. Now, this is the official charging section for income taxable under the head Salaries. It might look like just a tiny section on paper, but trust me, it is the absolute bedrock of salary taxation. So grab your notebooks, get comfortable, and let's decode this whole thing step by step.
Quickly, here's our roadmap for today. First, we'll be decoding Section 15. Then, we'll compare salary due versus advanced salary. Third, we're going to look at taxing salary arrears. Number 4, we'll cover some crucial exceptions and caveats. And finally, we'll wrap it all up with a quick Section 15 revision.
All right, let's jump right into Part 1, Decoding Section 15. What you're seeing here is the actual official extract of Section 15 straight from the Income Tax Department. You'll find it sitting right under Part B, Salaries. Now, you know as well as I do, whenever you're dealing with tax law, grounding yourself in the exact statutory text is just absolutely vital. The specific wording you see here, that dictates how literally millions of assessees are taxed every single year. So let's break down what this text is actually trying to tell us.
Okay, so here is the crucial takeaway. Section 15, it's not actually about how much tax you pay. No, it's fundamentally about when you pay it. It determines the exact, precise point in time that salary income becomes chargeable to tax. And in the world of taxation, timing is literally everything, right? I mean, a shift of just one single day can push a tax liability into a completely different financial year. So, Section 15 sets up these timeline rules, so there's absolutely zero ambiguity between the taxpayer and the tax department.
Moving on to Part 2, let's talk about salary due versus advance salary.
So the absolute golden rule of salary taxation that we get from Section 15 is this: salary is taxable on a due or receipt basis, whichever happens earlier. It's that simple. Under Section 1511A, any salary due to you from an employer in the tax year is taxable, whether they actually paid you or not. The mere accrual triggers the tax. But on the flip side, look at Section 1511B. If your employer gives you an advance, meaning they pay you before it's actually due, the tax department, well, they don't wait around. It becomes taxable immediately in the year you get paid. The government is essentially saying, hey, if the money has accrued, or if it's already sitting in your bank account, we want our share right now.
Let's make this super practical. Imagine an employee in this exact situation. He tells us, hey, my March salary became due on the 31st of March, which is in the current tax year. But my company didn't actually credit my bank account until April, which is the next tax year. Now, what happens? According to Section 15.1a, because that salary became due on March 31st, it is taxable in the year it became due. It completely ignores the fact that the actual cash payment was delayed. In this case, accrual takes total precedence.
All right, now let's flip that scenario completely and look at advanced salary. Like we just talked about with Section 15.1.1 by B, if you receive your salary before you've actually put in the days to earn it, that receipt basis instantly triggers your tax liability.
This next example illustrates that concept perfectly. Think about this employee's situation. Let's say she had a personal emergency, right? So she asked for and received 3 months of her salary in advance. Now, even though she hasn't actually done the work yet, and technically that pay belongs to a future working period, she's got the cash in her hands right now. So Section 15.1b kicks in immediately, and that entire advance amount becomes fully taxable in this current year of receipt.
Okay, that brings us to Part 3, taxing salary arrears.
Sometimes an assessee might get a lump sum of money for past work that, for whatever reason, was never calculated or taxed before. And this is exactly where Section 15.1.1c comes to the rescue for the tax department. It basically says that any arrears of salary paid to you in the current tax year are taxable right now. But, and this is a massive, critical condition, only if they were not charged to income tax in any earlier year. So the law is making sure no income completely escapes the tax net, but it's also playing fair by double-checking that you aren't being taxed on something that was already accounted for. A really classic example of this is a retrospective pay commission revision. Just imagine an employee who suddenly gets a notice saying, "Good news, your pay scale has been revised upward, and we're backdating it by 3 years." Boom. They suddenly get this massive lump sum of arrears. Now, because that specific extra cash was never actually due and therefore never taxed in those previous 3 years, Section 15.1c steps in and mandates that it gets taxed in the current year, the exact year they finally received the check.
Let's move on to Part 4. where we look at some of the crucial exceptions and caveats.
First up on this list is Section 15.2. Now, this contains a tiny but incredibly powerful clarification. It states that the term employer actually includes a former employer. Now, why does that even matter? Well, imagine someone receives a performance bonus, or maybe a settlement amount, from a company they resigned from 2 whole years ago. You'd probably think, well, they don't work there anymore, so I guess it's taxed under income from other sources, right? Actually, no, because that payment stems directly from a past employer-employee relationship. Section 15.2 legally yanks that money right back under the salaries head.
What I find really interesting here is the inherent fairness that's actually built into the Act. Section 15.3 acts as this strict shield against double taxation. Yes, the Income Tax Department definitely wants its fair share, but it absolutely does not want to tax you twice on the exact same rupee.
Let's actually bring back our earlier employee example to make this crystal clear. Remember the guy with the advanced salary? He's saying, look, I paid tax on my advanced salary this year when I received it. So according to Section 15.3, that exact same salary is going to be completely ignored for tax purposes next year when it technically becomes due. And honestly, it makes perfect sense. The receipt basis triggered the tax in year 1, so the accrual basis in year 2 is just bypassed entirely to prevent you from being taxed twice.
Now, let's just pause for a second. I want you to consider a super common business structure, the partnership firm. Lots of working partners receive a fixed monthly amount, right? And everyone just casually calls it a salary. But legally speaking, for the strict purposes of the Income Tax Act, is a partner actually an employee of their own firm? What do you think?
Well, the answer is a definitive no. And Section 15.4 explicitly clears this up. Any salary, bonus, commission, or remuneration that a partner receives from a partnership firm is absolutely not regarded as salary under Section 15. Why? Simply because you cannot be your own employer. The most fundamental requirement for the salaries head is having an employer-employee relationship, what lawyers often call a master-servant relationship. Since the partners actually own the firm, that relationship just doesn't exist. So that remuneration is instead taxed under the head profits and gains of business or profession.
All right, we've covered a lot of ground. Let's head into Part 5 for a quick Section 15 revision.
Okay, here are your 6 golden takeaways to lock this in. 1. Salary due is taxable even if it's sitting there unpaid. 2. Advanced salary is taxable immediately upon receipt. 3. Arrears are taxable on receipt, but only if they weren't taxed previously. 4. The legal definition of employer stretches back to include your former employers. 5. The law actively protects you. Advanced salary is never, ever taxed twice. And 6. A partner's remuneration, no matter what people call it, is not considered salary under Section 15. If you can understand and remember these 6 points, you've pretty much mastered the charging section for salaries.
But I want to leave you with one final thought as we wrap up this explainer. Section 15 is really just the gateway. It forms the foundation because it dictates the when. But once you've figured out when the salary is taxable, you have to step into the incredibly complex world of how much. I mean, how do allowances work? What about perquisites like rent-free accommodation? What kinds of deductions can you actually claim under Section 16? You see, Section 15 opens the door, but the rest of the Income Tax Act builds the entire house. Keep that curiosity going as you continue your studies and practice. Thanks so much for focusing in with me today, and I'll catch you next time.